fixed income, everybody's most sexy topic. I actually do think it's more interesting than equities. You're probably biased as well.
100%.
One of the things that we talked about when we spoke last week, I brought up the fact, as a client-facing advisor, bonds have been the most hated asset class pretty much since the great financial crisis. Why is that?
Well, when you think about the post-GFC 0% world, no one cared at all about fixed income legitimately. Now it's an asset class that has income, which is one of its primary objectives, is to provide income. So you can get mid-single digit to high single digit returns out of the asset class. It has liquidity, which is also one of the key attributes it's supposed to provide. And unlike when we kind of went into COVID and you saw that whole period through 2022 where zero rate world rose to a 4 or 5% world, fixed income didn't provide any hedge against negative equity outcomes. As we sit here today though, and we're seeing it actually certainly this year, fixed income now has income, has liquidity, and is providing diversification from your equity portfolio. So when you think about those attributes and returns that we think will be competitive with equities, we're not in the big bear equity camp, but it'll either be competitive or dramatically outperform. It becomes a pretty attractive asset class to have in the asset allocation of your portfolio.
Okay, but people still hate bonds. Dan, is this just a marketing problem?
So I think I caught the last question on the last panel, and the question was, what are the private credit guys going to be talking about next year? I think they'll be talking about how they should have bought bonds instead. So I think there really was a problem in 2022 because the bond guys and asset managers encouraging diversification promised that diversification is going to work when you need it the most, and clients needed it in 2022 and it didn't work. And that is because diversification is great, but there's still math. And when the 10-year bond is at 1%, it just doesn't have enough of a cushion to provide you that ballast. And I think there's just such a level of disappointment from what happened in 2022 that investors are still a little bit of traumatized. Just as, as Tony mentioned, the yields are attractive, they do provide the diversification benefit, and people should be looking at the opportunity to add bonds to their portfolios.
The other thing I'll say is that people obviously invest often looking in the rearview mirror. You're just coming off of 2 years in a row.
No way.
25% almost returns each year, right? So the equity asset class had that momentum. Don't miss out on the Mag 7, all of that storyline, and it kind of came to a pretty abrupt halt here in the last couple of months.
Yeah. So then let's talk about interest rates. We went through ZIRP. Huge bump up 22, didn't get the diversification. That was such an aha duh moment for me. Bonds aren't going to provide diversification if you're pretty much at the bottom. How are you feeling about interest rates now? How should advisors think about duration in their portfolio? Where should we be?
So I'll take a stand of this one, and I have to give you guys a disclaimer. So I'm actually a bond bear. I don't like rates. I think they're going higher long term. But we're long. And the reason we're long is, and we're probably the longest we've been in a long time, in definitely a couple of years, and really very constructive on duration, is simply because the risk reward has changed, and the fundamental valuation of the 10-year treasury is probably the most clearly, fairly attractive asset out there, anywhere. So you had a lot of things that could have driven rates higher. You had the concerns about the fiscal priorities coming out of Washington. You had potential that the economy was super resilient despite the Fed, keeping rates at a high level. And now we have clear evidence that the economy has begun slowing down a number of months ago. And the market has a lot more confidence that you're going to have a more balanced approach to fiscal policy in the U.S. And that means now the risks are to the downside. And there's certainly plenty of those. Not only are people concerned about just the investability of the concentration of the equity markets, but you have real risks that things could slow. And with the Fed essentially being stuck and really watching for some decisive evidence before they can cut rates, you can see quite a bit of a slowdown in the economy, and the only way to capture that is via longer term rates.
Yeah, so our view, I'd say, was slightly different. We're not long-run bears on fixed income or rates. We're also not near-term bullish on rates. We think fair value for the 10-year is around 4.5%. We'll trade in a range, which we've been in so far this year, 4.25 to 3/4. We think you're going to get, the extension of the tax cuts, so there's not going to be any deficit reduction that takes place. So all of these elements to us point to kind of fair values around here. Don't expect a big upside from declining rates unless your base case is a hard landing, severe recession, which that probability has certainly increased over the last couple of months, but it hasn't turned into our base case. So we get to fair values around where we are. We think income is going to be the main driver of returns for the portfolio. But we do think that if you are bearish around a big 20% correction in equities, big hard landing in the economy, then duration is going to work. High quality duration, treasuries, the 10-year will rally significantly. The one area that we think is particularly attractive when it comes to high quality, long duration is in the municipal market. Because if you look at the yield curve from 2 years to 30 years, and you look at it in the taxable treasury market, it sits at around 50 basis points, 50, 60. Whereas in the municipal market, over the last month and a half or two, it's widened out by 50 basis points to today being about 150 or 60 basis points. Significantly steeper, significantly better value in the long end of the municipal curve as it's basically struggled with digesting supply, digesting some outflows for people paying for their taxes this year. So long duration is going to work in a real hard landing equity market correction world, and the muni space is where it's probably most attractively priced.
So you asked us earlier, right, why bonds have a bad rep, and I think you do have to acknowledge that in the United States, the tax treatment of bonds and taxable accounts is not particularly attractive, right? And this is where, we have a great muni lineup as well. I don't work on it myself, but it's a great product. So if you have a tax-exempt account, I think you'd be silly not to have a bond allocation. But if you are managing a taxable account, I think talk to your accountant.
You said something that we didn't talk about last week, long-term bear for bonds. Can you elaborate? What's the rationale for being bearish long-term?
I mean, I think the big picture out there, and my background, I've been an emerging market investor for 20 years. I've seen a lot of countries get themselves in trouble and get themselves out of trouble. But the level of government debt in the developed world is at a very, very high level. And ultimately, that's going to means higher borrowing costs. So that's something you do have to be mindful of. You have to manage your risk. But that's a long-term risk. And most likely, the cyclical is going to overwhelm anything that happens in terms of the secular trends and rates. And my job as an investor is not to figure out what's going to happen. It's going to be to figure out what happens first. And I think the first trade is yields are going lower.
And Tony, you talked about hard landing. Are we still landing? I lost track of that a long time ago because there was the soft landing, the no landing. Sounds like with you in the short term, you're not expecting any sort of severe contraction economically. How do you look at things from a macro view? Because there's a difference between what you're saying about your short-term and your long-term view on rates.
Yeah, so in terms of the economy, our view has been that we're going to slow down. We're going to see kind of 2%, maybe 1.5% to 2% growth by the time we get to the end of the year. The risk is with policy mistake over these next couple of months. So if you think about what's been going on and what you may have anticipated on election day, right? The way we look at it as, while we would expect that there would have been some, government cost cutting, for example, when you look at what they're actually doing, what DOGE is doing, it's been far more aggressive, far more chaotic, I think, and far less disciplined than anything we would have expected going in. If you think about tariff policy, again, we baked in a level of tariffs for this year on China, on autos in Mexico and Canada, but the way tariffs have been used has been more aggressive, higher levels, a little bit more of what we call tariff ping pong, put them on, take them off. So it gets very difficult to determine what they're going to be. So what you do is you sit back and maybe you don't spend if you're a consumer, and you certainly don't invest if you're a company in large projects, capital equipment, business investment. So the risks of that downside have increased as a result, in our minds, of policy. So that's what kind of leads to, in the near term, we could see certainly a rally in rates, a policy mistake, you get the big drop. But longer term, we think the reason 4.5 is kind of our fair value is for the reasons of too much debt, no real plan to attack it, high fiscal deficits are going to continue for a long time. So the world of 2% inflation and a 1.5% real rate and 3.5% 10-year, those are long gone. The term premium is going to be higher. And in a world of high levels of debt, U.S. in particular, once you get to levels that are 5% or north of that, they really begin to slow down the economy. They slow consumer spending, they slow business investment, so they serve as a natural brake on higher rates because of their impact on actual growth, spending, profits, income, et cetera.
So I would make just a quick point. I do think what's going on with the cost cutting and Doge is important, and I think you have to separate things into things we know and things we don't know. We don't know what the ultimate cost cutting is going to look like, but we do know that whatever is going on has given the market a lot of confidence, and the confidence that the balance between spending priorities and savings is going to be much more in line than I think a lot of people expected after the election. And we also know there's a lot of spending being delayed. So when you have an economy that, let's face it, the government spending has been a big part of this economy for a long time, and you start delaying government expenditures, even if they ultimately do materialize, it's going to have an impact on growth. And we have a huge part of the financial market ecosystem, the consumer ecosystem, the corporate confidence ecosystem that is reliant on confidence, right? Fundamentals are strong because the consumer has jobs, because they're spending, because corporations are investing, because the stock prices are high. You start putting a little bit of a kink in the armor of the bull market and equities, and all of a sudden a lot of this confidence goes away. And that's why I think the downside risks are clearly there much more than they were 6 or 10 months ago.
Yeah, so it sounds like the vibe session Kyla Scanlon's been writing about is a real thing. Let's switch gears and talk about spreads. Corporate spreads have remained extremely tight. Is there a good reason for that? Should we expect them to stay tight? What are we looking for with corporate spreads?
I'll start. So spreads, as we say, they're full for sure. We've seen some widening out here in the last couple of weeks with the equity market downdraft and all that, so they're in a slightly better place. But the fundamental reason that they're so tight, there's a couple. One is that, hey, fundamentals are actually pretty good. When you think about corporate earnings, debt to cash flow, interest coverage are all solid. When you look at the lowest quality tiers, so go into high yield and leverage loans, and you look at default rates, they're running well below historical averages, almost all-time lows. They are anticipated to remain low. Liquidity for financing has remained wide open and high. So the amount of capital chasing debt, whether it's private markets, public markets, it's pretty substantial. So financing's easy. So the dynamics around credit are generally pretty positive, driving those tighter spreads. Having said that, our view is that we are going to see some widening. We've seen some. We think we'll see some more. But unless you're in the hard landing camp, which is what would drive defaults to above historical averages, we think you're likely to remain in this kind of lower spread, tighter spread range for quite some time until you get a catalyst to break out of that, which is typically going to be a hard landing. There's not a catalyst to take us significantly tighter in our mind, but you need that catalyst, which, again, that probability has risen. We think policy is going to be the main thing that could drive us there, and the uncertainty around that is high. So we think you want to be defensive in your credit risk taking, so higher quality ends of below investment grade, for example, higher liquidity in your credit portfolios. But it's largely a function of pretty strong fundamentals.
So if you think about what happened during COVID has been really good to investment grade companies because not only did the government essentially bail out the private sector, taking the debt onto its own balance sheet, cleaning up the balance sheets of these corporations, but also they were able to extend their debt at very low interest rates. So the sector is in good shape, and I'm going to agree with Tony. I think you have to worry about the risk down in the credit quality spectrum, and even though those spreads are tight, they're tight because the companies are strong, and as long as people find value in bonds, they're not just going to buy government bonds, they're going to buy corporate bonds, they're going to buy MBS, they're going to buy other high quality sectors, and I think in those sectors we would see widening as an opportunity to add. And yes, the spreads are not screaming by here. We're defensive as well. But what we're more concerned is the high yield market, for example, versus the IG market.
Yeah, there were a lot of charts going around when interest rates bumped up a few years ago showing, high yield companies when their debt was going to have to be restructured or rolled out. Has any of that come to pass? Are we even starting? It's almost a little bit shocking that there haven't been more defaults in that space. Are spreads properly pricing in the risk in high yield right now?
Yeah, so the maturity wall has been pushed out pretty effectively by companies. So the capital markets post-COVID, there was a big fear because there were maturities. You didn't know what the markets were going to look like in that early post-COVID period. But what eventually happened was that the markets were wide open for financing. Money is pouring into, again, private credit, public markets. So companies were very effective in pushing out, companies and countries, in pushing out their debts. So the maturity wall is very manageable and not going to be the driver. The liquidity is not likely to be the driver unless capital markets completely shut down. So we think it's going to be more of a fundamental issue that would potentially, drive the dislocation. But again, companies, as mentioned in investment grade space, pushing out to longer maturities, below investment grade, just pushing it out a couple of years. You're seeing that across the board. And so the market's in a pretty healthy spot from a liquidity risk and refinancing risk standpoint.
I guess the one thing to add here is you have to understand the upside as well here, right? So if you look at U.S. high yield bonds, there's a reason why spreads are tight. And I think Tony went through a lot of those reasons. They're all really good reasons. But this is a short duration asset class. There hasn't been a lot of issuance. The bonds are getting shorter. Spreads are near historic tights. And the best you're going to get out of this asset class is the carry. You're not going to get a lot of capital appreciation. There simply isn't enough duration. Bonds aren't long enough to appreciate in price, even if things do go tighter from here. So you have to balance the lack of upside against the valuations. And even though in most situations you can justify the levels today, the upside simply isn't there.
The one thing I'll add too is that, people buy yield, right? So when you look at, say, the high yield market, risk premiums or spreads, they're in maybe call it the bottom third of their historical averages, so tight. But if you look at their yields, they're in the top quartile, top third of highest yields the asset class has had over 20 years. So you talk to a spread buyer, they say, it doesn't look all that great. You talk to a yield buyer, they love the asset class. So again, a lot of investors go in saying, well, I can earn 4 or 5% in my high quality portfolio, or I can go into high yield and earn 7.5 or 8. And if you look at that, the yield's pretty enticing. Start doing the work on the fundamentals, they seem okay. Start looking at your equity market portfolio that's got a high multiple, and you say, these are these kind of lower quality segments of the market in leveraged loans, emerging markets, high yield CLOs, they end up looking pretty attractive.
A couple times you've mentioned there's buyers there. That's why we're seeing interest rates kind of suppressed and yields lower. Seems like there might be just too much money out there. So where are you actually seeing opportunity in the bond markets today?
So I think in terms of buyers, right? And again, this is going to get a little bit away from my area of expertise. But if you look at what's been going on, right? Again, 3-4 months ago, we didn't know where the economy was, before the election. Now we know where it was, and it's been slowing, and you can see it in the performance of the most kind of speculative, most growth-sensitive assets. Think about what's been going on in crypto recently. Think about what's going on in growth stocks. That is a testament of some of that liquidity being withdrawn, of the federal rates probably being high enough to start slowing the economy. So from that perspective, I do think that you have to pay attention to what's going outside. In terms of opportunities, in the same funds, like our Core Plus funds where we are underweight U.S. high yield, We actually have a modest overweight to emerging market bonds, focusing on kind of shorter duration bonds, higher quality issuers. That sector has been a little bit less loved, less supply-demand imbalance, and therefore wider spreads for higher quality products. Of course, as an active manager, we do want to keep some dry powder. We do want to hold some treasuries. We do want to hold some MBS because we want to make sure we're in a position to rotate to these sectors when they do underperform and become more attractive.
Yeah, I would say there's a couple of areas that we think are attractive right now. So if we think of like the tax-exempt market, I mentioned long duration, high quality is very cheap because of a steep curve. Lower quality munis, high yield munis, also generating a very attractive after-tax return with solid fundamentals. So that's one asset class for kind of the tax-advantaged investor. When you think about the public markets and private markets, a couple areas we like there. We do think that because we're not expecting the Fed to cut dramatically, we think maybe we get 2 cuts towards the latter part of this year, you're still going to have pretty elevated short-term rates. So a lot of floating rate assets look attractive in the CLO world and the leveraged loan world for higher quality below investment grade segments there. And another area that we like is securitized. And we think that in securitized, there's a variety of different ways to play it, but we think about, for example, in the asset-backed market, some of the digital infrastructure assets. In the commercial mortgage-backed market, there's single property deals, single asset, single borrower deals that are attractive. And in a lot of securitized space, it's one of the few areas in the market that is, not 100%, but highly insulated from a lot of this tariff policy back and forth. And, is my company's inputs going to get tariffed, and so my costs are higher? Am I not going to be able to export because of retaliation? The mortgage market doesn't really have that. A lot of the asset-backed market doesn't really have that. So you have a little bit of insulation from that standpoint as well.
So I do want to kind of have one note of caution. Normally, I'm a huge fan of short duration products. If you can pick up a little extra yield by going into ultra short fund, short duration fund versus money markets, it often makes a lot of sense. But it makes sense when you have A, an upward sloping yield curve, meaning you're getting higher yields, and B, when you're not worried about credit deterioration, and C, when you don't need the actual potential price appreciation in the downside scenario. If the Fed is stuck at this level for 9 months, the short duration, or maybe longer, the short duration bonds are not going to give you that upside. So if you do need the upside, you do need longer duration. So right now, I would probably lean a little bit away from short duration strategies. If you want to have money in money markets, that's great, and I would just balance with some exposure further out the curve.
Let's shift gears a little bit to how to invest in fixed income. Advisors have, there's SMA strategies, ETFs, mutual funds. What are some of the things that we should be thinking about for pros and cons for each type of product structure?
I can talk a little bit. We don't do SMAs. We have both ETFs, active ETFs, and mutual funds. It's really just about what's right for the client. ETFs have a lot of benefits. They're easy to use. Also, in the early growth stages, the ability to protect the clients from inflows to make sure that existing holders don't pay for somebody else's transaction costs is really attractive. So any asset class where you don't mind the daily disclosure of positions, ETFs are a great option, and mutual funds are a good solid option if that's something you have access to. Separate accounts, that's really much more about, again, somebody between you and your advisor, right? As an investor, they don't make any sense. From our perspective, they don't make any sense because you want daily liquidity. You have a mutual fund, you have an ETF. You're going to have often a second, third rate investment team managing that stuff. They're constrained. They don't have access to resources. So it's really whether the benefits to manage your taxes, the peace of mind of knowing exactly what you own, those intangible benefits are worth the economic losses.
So I generally agree with the ETF mutual fund comments, not the SMA comments. I don't think you get a third-rate team. Nuveen, we're a huge SMA player. It's the same research team that does it, through the same trading desks. So there's advantages, and again, you do want to talk to your advisor, but there are some advantages to how you can structure your portfolio, what kind of tax management you want to do with that portfolio with individual securities. I would say that if you go into lower quality, less liquid asset classes, That's where the SMA, to me, is not as attractive, because that is where you want the greater liquidity that's offered by the more broadly diversified products, such as ETFs and open-end mutual funds. And then also, if you go into kind of some of the lower liquidity areas of the market, and private credit would fall into that, for example, then you can get into some other structures, whether it's around closed-end structures, interval funds, because you begin to, I think, get some of the benefits of the asset class in terms of higher yield and diversification from it, but in a structure that it doesn't have a mismatch between the structure's liquidity and the asset class's liquidity, because that can become very problematic depending on the market environment and what an investor has to accomplish. So, being in a vehicle that provides some cushion between that daily liquidity of an open end and an ETF and the lack of daily liquidity in some of the asset classes, that's an important consideration when you're going into those, again, less liquid, deeper credit segments of the fixed income market.
Tony, can you elaborate a little bit on some of the specifications you can get with an SMA strategy, particularly when it comes to a tax-exempt side, some of the things that the benefits that clients can get based on location or credit quality, duration?
Yeah, so you're really able to customize far more effectively, and we offer both. So there's plenty of our clients that are in our mutual funds and closed-end funds, et cetera, but a lot are in SMA because they might have, a certain state-specific requirement, or they might have a certain maturity structure they're trying to accomplish because of what their retirement plan looks like in terms of their spending, funding, et cetera. So you can customize whether it's your state needs, whether it's your kind of restrictions you want to apply to certain segments of the market. Maybe you don't want housing-related deals because you are a big property investor yourself. So there's all kinds of reasons that you can get customization in SMA that meets your investment objectives, your risk and return objectives, that you can't always get out of the mutual fund. So it's about balancing those and determining with your advisor, well, what is my objective? What am I trying to achieve? And often the SMA can be, again, tailored more carefully and specifically to what those needs are.
And would you say there's a certain dollar amount at which the SMA becomes beneficial versus not? I mean, at a certain point, to get diversification and transaction costs, like what levels should we be thinking about if we're going to consider an SMA?
Well, what I would say is that if you'd asked me that question 5 years ago and 10 years ago, there were some very tangible numbers to that. But with the compression and pricing that's gone on across all of our world, fixed income and non-fixed income, but especially across product types like or structures, open-end, closed-end, et cetera, SMA pricing, which used to be higher, has come down pretty dramatically, so that now you really don't get into a pricing issue for anything that's really over, I would say, probably in the neighborhood of like $50,000 or $100,000, because pricing has come down and the technology has helped in terms of client reporting, portfolio risk analytics. So it's much easier to manage a large number of clients from a lot of these client servicing perspectives that before was a constraint as well, so you wanted to have higher minimums to it. But between technology and cost pressures, it's really kind of leveled the playing field quite a bit.
But I think liquidity is also a big factor, especially with working with private investors. How do you properly quantify or even explain the benefits of liquidity that you would get in certain products or certain areas of the market? It just seems like hard for clients to grasp how to gauge that. Do they just have to go through a market downturn and learn?
So I do want to add here. I think we might have slightly definition for what low fees are given where I work. So maybe that's some of the differences in the view of the separate accounts. But in terms of liquidity, and this goes back to how we started this conversation talking about diversification. A lot of people in this audience, a lot of the clients are essentially equity investors. They believe in the U.S. equity market. They want to believe in they want to invest in the U.S. equity market. If you can get into S&P 500 20% below, they'd love to get back in, right? Even if they're selling today. And you can only do that if you don't give liquidity, right? So the two essentially rules of diversification is, one, you should never buy something that has no fundamental value solely for the purpose of diversification. That is called wasting money. That's not diversification. So everything you buy has to have a fundamental value, right? And two is If you're diversifying, the idea is you want to go back into equities, well, you buy a bond mutual fund, and let's say the scenario plays out that equities are down 20% because we're in a slower growth environment. You probably made 8-9% on that fund. You sell it, you go back into equities. Let's say that's not what happens. Let's say there is a stress on funding for government. So equities are down 20%, but bonds are actually down a little bit because you got the yield, but you lose a little bit of in appreciation. You're down 1%. You still sell them, and you buy equities 20% lower, right? But if you get yourself into something you can't get out of, you've lost that optionality.
Yeah, and I would say to your point of do they actually need to just live through a bear market? I mean, that's typically the case, right? Liquidity doesn't ever matter to anybody until the actual day they need it, right? So that's where an advisor often comes in, of being able to provide that guidance to an investor. So the other thing I would say about liquidity is that if you think about just over the last 5 to 10 years, the movement towards kind of the Yale model of investing and having more venture capital and private equity in these asset classes that literally are 7 to 12-year type of horizons, which was 0% of your typical individual investor's portfolio, and now has moved up to 5, 10, 20, and 30%. So the need for liquidity when 10 or 20 or 30% of your portfolio is appropriately in higher returning, well-diversifying assets like private equity venture capital has increased substantially. So that's one of the attractions of fixed income right now, that if you're doing that in your equity book, which makes a lot of sense, then you're going to want to make sure you're offsetting that lower liquidity with higher levels of liquidity in your fixed income book, which again can lead you to lots of different areas of public markets and different structures. But we do think the importance of liquidity has risen for most investors as a result of the democratization of private assets.
Yeah, and I mean, if you're in a situation where you have a fund that you invested in that is not giving you money back because they've closed the gates, you're trying to get your money back out of every other investment, no matter how unrelated it might be, where you have limited liquidity, right? So you can really have a stress on the system at some point if people do panic and try to get their money back.
We've certainly seen some of that. Let's talk for a little bit. You mentioned active and passive. We didn't touch on that in our prior conversation, but I think it's a good question. A lot of advisors have gone towards passive investments in fixed income, but it's not really passive, is it, if you're following the ag? The ag is changing over time, and can you talk about some of the benefits or drawbacks of being passive versus active?
Yeah, so passive to us, the big thing in fixed income is there's a lot of evidence around the ability for fixed income managers to outperform indexes. Part of the reason is that most fixed income indices have pretty significant concentrations, right? The ag is kind of the biggest 800-pound gorilla out there, tremendous amount of treasuries, mortgages, high-quality assets. That's been the case for the ag forever, yet the broadening of the fixed income market over the last 20 years to other aspects like the growth in emerging markets, the growth in CLOs, the growth in leveraged loans and high yield has been dramatic. But the ag hasn't really adjusted that much from a composition standpoint. So it's no longer all that reflective of the broader fixed income market. Similarly, you would say that I think in the equity market that, the Mag 7 or 30% of the concentration risk in the S&P 500 is pretty high. The number of companies that are available to invest in now because of the growth in private equity, for example, and in global markets has dramatically increased. So the whole passive storyline, I think if your objective is large cap US equity exposure, it makes a ton of sense. It's free, and there's not a whole lot of security selection differentiation that's available. But when you have a broader objective of whether it's on the equity side or the fixed income side, to go through what are the traditional indexes and the ones most available in fixed income, I think you miss out on lots of parts of the market that are not captured by those indexes, and on the ability of a good manager in emerging markets or other areas to actually outperform those indices through strong security selection.
So, essentially, the one way to kind of simplify the reason why active investment seems to work so much better in fixed income than other areas is if you think about who the players are in fixed income, there are a lot of non-economic players, right? You know, the Federal Reserve can be a huge player in the fixed income markets, insurance companies. There's a lot of people doing things that are not trying to optimize alpha. So that does leave alpha around for the skilled managers to pick up. But I do think there are three caveats, right? So if you're going to pick an active fund, and I hope you do because I'm an active investor, you have to be able to do three things. First, you should make sure you can select the manager, and you and your team has a skill set to do the due diligence and manage the selection. Two, you want to make sure that manager's alpha is not being paid back to the manager in the form of excessive fees. And three, you want to make sure your investment horizon is long enough where an active manager can add value. Because if you're buying something for a week or a month, like nobody can guarantee alpha over a short period, right? We try to outperform over the market cycle. So in those situations, if you can find yourself a good active fund, you should buy it.
Should you consider at all the personality of said active manager when selecting a bond fund?
Well, I think most people buying the fund don't have access to determine the personality of that portfolio manager.
You're on television?
But, you know, there is a lot about behavioral finance that talks about what's the best kind of whatever mindset that an investor can bring, and is it a questioning mindset, a confident mindset, all those things. I think if you're dealing with some of the larger players in the industry, whether it's a Vanguard or a Nuveen and others, very rarely do you have portfolios that are really dominated by a single personality. There's a deep team, the researchers, the traders, assistant PMs that are helping, macroeconomists, risk analytics people. So it probably doesn't become quite as important of a question as it might in a, you know, again, star-dominated type of situation.
I think you should look at the track record. And the track record is not just about what's the best fund in a particular 2 or 3 year period, right? You're always going to have a manager that's going to have a particular skew that's going to be more advantageous for a particular kind of market, right? You have to look at performance on a granular basis. You have to see how active the manager truly is. Are they just staying in the same position the whole time? In which case, they've only had one trade on. Even if they got it right, it's 1 out of 1. It doesn't count, right? You have to look at, you know, how dynamic the management is, and you have to see how they've managed risk through periods of volatility, right? So if you look at the COVID crisis, you look at the 2022 sell-off, and that's why it's so hard to select a manager, because it takes a lot of work.
We didn't touch on private. I know there was just a panel before this on private, but you do at Nuveen have some investments in the private markets. How should advisors think about doing due diligence on private investments and figuring out if that asset class is right, and then where to go within the private space?
Yeah, sure. And I listened to some of that, and they made some strong points about the manager selection is critical. And there's a couple elements, and one in particular that they talked about, which we think is very, very important, is really in private credit. What is the manager's sourcing strategy? There's a couple of different ways people can do that, but having the breadth of relationships and the historical ability to provide funding to the private equity counterpart that's looking for that, that's a pretty significant advantage in a market that's having a lot of capital sent into it in terms of being able to, again, deploy it, but deploy it effectively. So having a sourcing strategy is good. Having long-term relationships so that that private equity firm knows that you are someone that they can have worked with through stressful periods. So it doesn't really matter what happens in the first 6 months or a year of a deal. It's when the stress happens, how do you work with the private equity partner and the private credit lender in order to, again, work through the inevitable hiccups that occur. So the sourcing strategy is key, the track record is key, and the ability to do the credit research, the underwriting is key. And you can see that through historical data on what type of underwriting does a manager do. So what are the debt to cash flow levels at the underwrite, the interest coverage levels at the underwrite? Because in private credit, with the movement to larger funds and larger companies going into that market, you've had a loosening of some of the underwriting standards in the higher market cap companies. the ones that can really play off, hey, I'll go to the public market or I'll stay private unless you offer me, again, looser covenants, tighter spreads, whatever. When you think about the traditional middle market space, companies that sit between 50 and 200 million EBITDA, which is the majority of that market, that's where the underwriting standards have remained solid, the interest coverage levels have remained solid, and that's where the partnership, the sourcing partnerships are more critical and longer term. So the newer players aren't really able to break into that are raising the $10 billion funds and having to go into the higher market cap companies.
Seems like you almost have to have an expert in-house too to be able to go through some of those, but hopefully some good partners like Nuveen can help you. We have just a few more minutes. I'm just curious if anybody in the audience has a question while we have these two amazing panelists on stage with us. Nobody? Is everybody ready to go rock out tonight, or what's going on?
I think we're in between. We're between the audience and the happy hour.
Yes. Is there concern about with MBS having negative convexity if we go into a higher interest rate scenario?
Yeah, I mean, there is always. Now, the market happens to be at a spot right now because we've gone through this kind of rise in rates outside of the more recent little drop in rates, that it's more positively or less negatively convex than historically it has been. So there's some, kind of protection from that front. But yeah, coupon selection is key if you're in the just kind of straight traditional MBS market, which we think is fair value right now. We think it has good liquidity. We think you're, again, a little bit insulated from any of the tariff risks. So mortgages are fair if you're just buying kind of very high quality AAA type of credit risk. So agencies, mortgages, AAA asset backs. The more interesting opportunities in mortgage land come in the non-agency space. So credit risk transfers is one example, some CMO product, non-agency product where the underwriting there certainly has some convexity risk to it, but is not going to be the main driver unless you're in the camp of, kind of going to a 5.5% to 6% type of world, and then you get massive extension out of that product. Or you're in the, hard landing, Fed's cutting back to 1%, and now all of a sudden, everything is refinanceable again. But those extremes, again, we don't think that's the likely outcome in the next 12 to 18 months.
So we are big investors in mortgages. In fact, my co-lead PM on a lot of funds I manage is a mortgage expert. This is one area, though, you do want to have some caution, right? Because I often say that, fixed income investing is not rocket science, except for MBS, right? Because that's where you really have the real brain power that's required to analyze the prepayment models and understand how things are going to behave. So that's where you definitely want to make sure that if you want to make sure you have a well-resourced team with the right tools and the right skill set to manage the risk in the MBS space. Non-agencies is a great opportunity, but if you don't understand the risk, you can get yourself in a lot of trouble.
Anybody else? Questions? I did want to follow up a little bit on emerging markets. That's a pretty diverse space. There's a lot of risks, trade policy, geopolitics, overall balance sheet of governments. Is there a specific area in emerging markets? Can you just elaborate a little bit more on the opportunity there?
So I would just say two things. A, please don't confuse us with emerging market equities. Emerging market equities is a very poor track record of performance, and there's a reason for that. It doesn't overlap with EM bonds at all. Even on a country level, we're talking about different countries. So different asset class, much cleaner, much better long-term performance track record. The asset class within EM that's probably the most interesting is the dollar bond market. So that's when you're essentially lending money to governments, sometimes government-owned companies, mostly governments. And what's interesting about that market is that it really spans the entire credit quality spectrum from distressed to AA. And that gives diversification to the indices, but also opportunities for active managers to really add a lot of value. But also, it's really the only asset class out there in credit that has both duration and spread. So high yield, we talked about it earlier, there's spread, but there's no duration. Investment grade, we talked about, has duration, but no spread. So you're not going to get a lot of capital appreciation from any of those things, unless, of course, it comes from just the interest rates themselves for USIG. Emerging markets, you have both. So when you get the stories right, you can make a lot of money. When you have an economic downturn and you start at a high yield level like you are today, you can really cushion a lot of the spread volatility with lower rates. So if you have if you are the build it yourself kind of advisor, I would certainly consider an allocation to emerging market credit, emerging market sovereign credit as part of your credit allocation.
All right. Well, I think we're out of time. Tony, Dan, thank you so much for making fixed income one of the most exciting panels of Future Proof. And I'll let you guys get to it. Thanks so much.